we're going to be talking about budgeting. This is one of the principal activities of management accountants. They're involved in what we normally understand as a budget, which is when you budget for something, you work out how much you want to spend on whatever, and you can spend more and be above budget. That's usually regarded as bad, or spend less and below budget. That usually is accounted for as being good, and it's much the same in a company. Here are our learning outcomes, and have a look at those. So we've not really defined, well, we've had a definition of sorts of a budget, but it's a plan. We can think of it as a plan, and it helps to coordinate various parts of the business. The sales in a production outfit, the sales have got to be matched with production. You can't sell something unless you've produced it, and so on. System of authorization, you're looking to the future. You have got to have a plan, and if it isn't in the plan, then it really needs to be separately authorized. So coordination, authorization, and together those really amount to control. So we'll call that control. And all this is also an example of forward thinking and identification of problems. Clearly, if you're going to put everything together, you're going to see that there are some difficulties in certain areas. So all those are the kind of logical planning aspect of a business, and that's what we're going to be concentrating on in this session. Now, we've got one box here which is not really elaborated on at all in later slides, so we just want to make a little special mention of this, and that is using budgets to motivate managers. And there's been quite a lot of research in the literature about that. It is essentially setting a target that will encourage managers to increase output or profit or whatever the target is. So the classic diagram is this one, where we have output being sales or something like that, so related to profit. So the more output, the better, essentially. And this is the budget, sales or profit target, whatever it is. And the orange line is where the managers, the actual output, achieve the budget. And the blue line here is what actually happens. So if the budget is set, let's get this line here, oops, let's just move it along. If the budget is set down here, where the budget is very easy, we can expect that the actual will exceed the budget. Then as the budget gets more and more difficult, so the output gets closer and closer to the budget, and then finally the managers just manage to meet the budget. And it's this area where it's thought that the budget might have a motivational aspect in this area, because what's happening here is that the budget is going up and up and up, and the actual is falling short of the budget. The budgeted output is higher than the actual. So there's what we call an adverse variance. They fail to meet the budget, but in failing to meet the budget, they nevertheless do better than just meeting the budget. So the blue line continues to go up here, and performance improves. Whether this works on an intertemporal basis is to be, in my opinion, doubted, as managers think, oh, they've set another impossible budget. We know we're not going to make this. So using it in a behavioural way involves this kind of thinking. Okay, so we're not going to be saying much more about that, but it's worth bearing in mind. The planning and control process, all these boxes here are really about working out amongst the senior managers what exactly they want, and then they convey the targets to the accountant, who has to prepare the budgets. And this little box here that I've added outlines all the things that have to be prepared. So the managers want a certain profit level. That is going to involve sorting out the orders, if it's that kind of business. All businesses are different, remember. Working out the costs to, I'd also put in whether the orders are going to be transferred into sales. Then when you've got your sales, you can work backwards to the costs, and then you have to work to balance sheet items such as your cash, your creditors, your debtors, that sort of thing, and then you finally come up with the profit figure and any problems along the way, such as you'll need an overdraft, how much you'll need, and that sort of thing. You then go to the directors and say, well, this is the profit level, and they will turn around to you and say, no, we want a little bit more, try and find some more. So you go back to the managers and ask them, can they increase their sales? Other managers, can you reduce costs, and so on. So that's the kind of thing that goes on in the preparation of the budgets. Then when the event has happened, the month has passed or the year's passed, you collect the information on the actual performance, you look at the variances, and then as managers you have to decide what you're going to do about the variances. How is it going to affect your decisions? If it's not affecting future decisions, then there's not much use in having the budget. So you want some sort of revision of plans that goes back into the decision-making process. In the black box is the higher level decision-making that needs to be undertaken before you can sort out what it is you're doing. Of course, a lot of firms don't really engage much at this level. They should do, and they just sort of say, oh well, we'll just have see if we can get 3% more profit next year. That sort of very crude strategic target, especially with small companies, that sort of thing. So trying to put it all together is something that I've hinted at as a process. We have certain items, I've been outlining them in green. I think I've got most of them. These are the balance sheet type items, and I don't know why that one's in that green, but that's better. So these are balance sheet items. We need creditors, can't go through the roof. We need to control our creditors. Debtors, we need to make sure our debtors are turning into cash. We need to make sure we've got enough cash. If it goes negative, we need an overdraft, which is a very common feature. We need to make sure we've got enough stock, right? And that's finished goods and raw materials. So all these are what we call balance sheet type items. And then we've got profit and loss account type items, the sales, the overhead costs, the labour costs, the raw material costs. And those things feed into the budget. And one thing that is a cost but is not in the profit and loss account is the capital expenditure budget, and that obviously takes cash, but it's not in the profit and loss account. If you're buying a lathe or a car or whatever, that goes straight into the balance sheet as a fixed asset and doesn't go via the profit and loss account. So all that goes to our production budget if it is a manufacturing outfit, and we tend to use that as our model. All this has to be coordinated, and I suppose you'd say the basic model for understanding it is the profit and loss account, or income and expenditure, or and the balance sheet. Those two together really tie up all the accounts and make sure that everything is, at least in the planning, going to coordinate. Sales budget. This is a kind of logical diagram. It doesn't always happen like that, but there is some form in most organisations, well, almost all, there'll be some form of breaking down of your overall sales. Companies don't just sell one product, they sell lots of products, or if they do sell one product, it's going to be in lots of different regions. How you split up those revenues, how you see your products, whether by division, whether by area, is part of the management decision making in laying out the plan for the company. It's part of the company's tradition. Right, sorry. Accuracy of budgets. This is a not sure about this source, but you must be very skeptical about these questionnaires. I would always say something like according to a questionnaire, and not treat it as fact. When business is given a questionnaire, they look at it, and I think there's quite a bit of what do you want me to say about it, rather than telling the truth. However, in this we see a little bit over, a little bit under, and essentially a model of planning that appears to be very logical rather than behavioural, in the sense that if you were trying to make a rational prediction, you wouldn't expect to be actually on plan. You would expect to be a little bit over or a little bit under, and it is like that in more or less equal measure, which is what you'd expect, and then a pretty symmetrical distribution for the very much over and the very much under, right? And the don't knows here, those are the honest ones. So it's almost a normal distribution, which is what you would expect in this process, that guesses are randomly wrong and not biased in their estimation. This is a cash budget. Everything has to be budgeted. We'll look at other balance sheet type items, but clearly in preparing a cash budget you are looking to see whether you're going to run out of money, and that's not the same as profit. You may be making a profit, but if your debtors are not paying, then you'll be recording a profit, but you'll have a cash flow problem. If your creditors are demanding immediate payment, then you may be making a profit, but if your debtors are not paying as quickly, then again you're going to have a cash flow problem. So the problems that come up with cash budget are separate from those of making a profit and making a loss, and it's important to realize that, because obviously in your own personal finances you equate cash with profit and loss. I benefited by £10 means that you got £10 in your pocket. For a business, I profited by £10 does not mean to say you've got £10 in your pocket. It may mean that just somebody owes you £10. So these are the receipts, cash coming in from debtors, which, as I've been saying, is not the same as sales. Then payments actual payments to creditors, and then these more straightforward actual payments. So it's not necessarily that you've used all this electricity. It might be a prepayment. You don't worry about that. The cash, the bill was actually paid then. Then other overheads, these are actual payments. And then a purchase of a van, that means you paid £11,000 in that month for that van. And that gives you the net position. So we've got, total payments position. So we've got 60 here, we've got 42, 60 coming in, 42 going out, a cash surplus of 18, and then a surplus of 10, a deficit of 13. So the cash surplus or deficit is the net figure. Right? the receipts less the payments. So whoops, that wasn't too clever. So we'll understand that as the surplus. So still can't get it in. All right, well, there it is. So that's the movement in your cash. Then you have the opening balance. So opening balance, that's, well, perhaps we ought to put that in movement. And we've still lost it. Oh, never mind. Right, so the movement is a surplus in that month of 18. The opening balance was 12. Together that makes 30, and that's the opening balance of the next period. The movement plus 10 added to the 30 gives us 40. Then minus 13 added to the 40, our balance goes down to 27. And this balance in a business might well go negative, and that would imply that you're borrowing from the bank or something like that. So that's cash. That's one of the elements. The other is, well, one of the others is the stock. So you work out your opening stock plus your purchases less your cost of sales gives you your closing stock. And this, for the profit and loss account, is done on an annual basis, but for a business they'll be wanting to work it out on a monthly, possibly a weekly basis, or even a daily basis. That you've got your opening stock, you've got your any incoming stock, so that will be purchase, that would be equivalent of incoming stock, and then what's used up, and that gives you your closing stock. So that's the cost of sales formula. If we look at it on a monthly basis, you can see that it's the same pattern, just repeated. I'm not putting all the arrows here, but it's much the same as the cash in the sense that it's what you started with, plus or minus the changes, and then what you've got at the plus the incoming less the outcoming gives you your closing stock, which is the opening stock of the next period, and so on, like that, and so in, out, balance, carry the balance to the next period. And it's as simple as that, and you need to understand the conceptual simplicity of what you're doing, because it can get very complicated when you're faced with lots of different types of stock from different locations and so on. Right, so we've been looking at the balance sheet type items, and one might add to that the creditors as well, which is handled in a similar fashion. Now for the view of the budget for the profit and loss account, and here we have our output budget, the original budget here, sales, the output, and from that output we've got our revenue, our costs, our labour and our fixed overheads. All these will be negotiated with the various managers, and so you come up with your operating profit that the directors and so on are happy with. So that's your original budget. Now the real world comes in, the year has passed, you prepared your actual, and you see what actually happened and compare it with what you budgeted. And the first thing to note is that you did not meet your budget in this instance. You only production and sales were only of 900 units, and so revenues are down, direct materials should be down, labour should be down, fixed overheads not going to be affected. Given that that's the case, a common explanation across all our costs, what we do is we what's called flex the budget and adjust the budget to be the budgets that we would have prepared if we had known that the output was going to be 900 units instead of 1,000. That creates an overall profit variance of 4,000 in this case. So it's just been a straight pro rata reduction of costs, a knocking off of 10%, right, because it's 10% less. So 20,000 becomes 18,000, 10% less, 40,000 becomes 36,000, 10% less. Fixed overheads we've left the same. So this is our profit variance. It is done in different ways. The management accountants do something called sales margin volume variance, where they vary the fixed costs and then adjust back. But we're not going to be doing that. Fixed costs should be fixed even in a flexed situation. So our profit is going to be £4,000 less. Now, this is the budget for the actual level of output. That is not the actual cost. The actual revenues and costs are given here, and you can see that our revenue is 2,000 above. And if we look at here, we've got direct materials. We've got the difference between 36,000 and 36,900. Basically, we think of two differences. One is quantity and the other is price. In other words, we use the very simple model that cost equals price times quantity. Of course, in the real world, where you're buying lots of different things at lots of different prices, there's another thing called mix. Your mix might change, but we're not going to worry about mix variances. We're just going to look at the difference as being the difference between price and quantity. So as in our flex budget, we do need the quantity. So it's 36,000 meters here, so £1 a meter, and 2,250 hours. So that £18,000 divided by 2,250 gives us our labour cost per hour. And again, we're just dealing with the simple quantity, in this case hours, and price, which is in this case the labour rate. So labour rate times the number of hours gives us our total labour cost. The actual price was cost of labour was 17,500. The actual usage of hours was 2,150. The actual material uses was 37,000 meters. So our overall variance on each of these costs is given here. 900 extra, it goes as red as a minus. 500 below our 18,000, so that's green, it's a plus. And our fixed overheads were more than we budgeted for, so that's a minus. So looking at our overall picture, we want to explain 20,000 going down to 16,900. So our total difference is we put the actual before budget here for profits, and we have our actual of 16,900 minus 20,000. We arrange it, whether it's budget before actual, actual before budget, we arrange it so that a straight subtraction. If it's negative, it means it's bad, we didn't do as well. If it's positive, it means we did better. So our actual profit here minus our budget profit 20,000 was higher, so that gives us our minus 3,100 as our total difference. If we add up all our reds and greens, we find that the greens add to 2,500, that plus that, and the reds add up to 5,600, so that's 4,000, 4,900, 5,600. And the total comes to minus 3,100, which is the difference between our operating profit and our actual. And that is essentially what a variance analysis is doing. It sounds a little bit involved. In practice, it's much more complicated, but you need to have this picture as the simple conceptual understanding of variances, because in a management meeting you might not have a full variance statement, but you might be looking at the difference between this cost and this cost, and you have to understand that a certain amount will be due to producing less, certain amount will be due to using less, and a certain amount will be due to a change in price. We can actually split it up into price and quantity variances. So our difference in sales revenue has to be a price variance because we've already adjusted for the quantity variance with our movement from here. So that's the quantity variance already catered for in that variance. So if it isn't quantity variance, it must be a price variance. And so that's the 2,000 there. And then for costs, it's budget before actual. Budget price, the price variance is budget price minus actual price, and it could be budget quantity, but by tradition we take it as actual quantity. And here budget quantity times minus actual quantity, and this again by tradition is done at the budget price. We have here therefore a split of price variances and quantity variances. We're saying that the budget price, which was £1 per metre, the actual price was a bit less than that, and times the actual quantity gives us a 100 favourable variance. The budget quantity was the flex budget was 36,000. We actually used 37,000, so it's a negative quantity there at the budget price of £1 per metre. So minus 1,000 is our negative quantity variance. I've not worked out the budget prices, but the budget price is going to be the budget cost divided by the budget quantity, and then the actual price is going to be the actual cost divided by the actual quantity. And similarly for labour, remembering that the budget price is the wage rate, the price per hour that the labour is paid. We just use slightly different words, that's all. Then the actual price, actual wage rate is going to be that divided by the number of hours that represents. And then we've got also a quantity difference. We budgeted for that, we actually got that, and we work that out at the budget price. Then the fixed overheads is just a straight difference, it's a price variance because there's no quantity for overheads. And in that way we have our total of our price variances, which comes out as 1100 positive, and our quantity variance comes out at 2000 negative. So comparing the flex budget with the actual, we actually did better given the fact that we actually sold less. So the main reason why in this example we didn't make the budget profit was quite simply we didn't get the level of sales that we wanted. Other than that, it would appear that prices were below budget and there was a little bit of adverse quantity variance, and they may be linked. It may be that you bought cheaper material and therefore you had to use more of it. So explanations are likely to cut across variances. Just to go over what we've been saying in very basic terms, we start out with budget profit and we look at all favourable variances, add that to the budget profit, and then we deduct the negative variances, and that gives us our actual profit. And that's what we were doing here. We started out with the original budget, we deducted the red negative variances, we added the green variances, and that came up with the difference between 20,000 and 16,900, which we worked out down here. So you need to bear this simple model in mind. Degree of importance attached to budgeting. Well, again, it's one of these surveys. It's attached to flexible budgeting, and it's not. You mustn't believe that everyone is doing it. And as you can see here, that the 4 and 5s, those who appear to be seriously using it, come to some 32%. So about a third are using it seriously. Occasional use, probably don't use it at all, or very rarely down here. And it tends to be the larger organisations that have a much bigger control problem compared to the smaller organisations where a lot of what ought to be happening is kind of in their heads rather than written down on paper. So that is the difference. It is a formalisation of a process that is in a small company often quite an intuitive process. If we look at published accounts, we can't really perform variance analysis. It requires greater detail, but we can at least see whether, as it says there, whether profits came from increases in sales or decreases in costs. So we can, even on a published set of accounts, we can still do a little bit of basic variance analysis. But that would be comparing one year with another. Right, okay, so that concludes our look at budgeting. It is, in many organizations, a very formalized process that requires a lot of organization and coordination, but it's very necessary to make sure that all the very different parts of the organization that don't normally communicate come together to form a plan, and that plan is centered around the accounts. That's not to say there isn't a lot of other aspects to the process. How did we arrive at the sales budget? How did we arrive at the purchasing and production budgets and things like that? So there are a lot of other factors, but the accounts kind of form the center of the process, and they help to coordinate and make sure that the plans are financially sound.